Hello and a very warm welcome to the Property and Investor podcast. My name is Paul Lanfear and I, of course, am your host. Now, nothing in this podcast, my inner lawyer, as you know, always needs me to tell you this. Nothing in the podcast is financial, legal or health advice. Do your own due diligence, and nothing in the podcast amounts to an endorsement or anything like that. But of course, you know that. Now, look, I'm absolutely thrilled to introduce today's guest. So today's guest is a economics market cycle expert, a forecaster, a writer, a speaker, and an international finance professional. And in his spare time, he's a translator as well. So a busy man. Akhil Patel, a very warm welcome to the Property Investor podcast.
Thank you so much for having me.
It's a real pleasure. So I've given that introduction, although I don't think it really does justice. I mean, glancing over your CV that you've put on a LinkedIn is pretty remarkable. So I'll give the headlines of it. Director of Property Share Economics, editor of Cycle Trends and Forecasting, an associate director of the European Bank for Construction and Development. I mean, the list goes on. You're best known for your involvement in the 18.6 property cycle, and you've published a book which we'll get onto. But how do we find ourselves here, Akhil? I mean, you've got a keen interest in market cycles and making, robust predictions. Where did your interest in the cycles start off?
Well, the first, I think, engagement with an idea of cycles actually goes back to my school days, and I was at a small independent school in London, and I came across the work of this economist of the 19th century called Henry George, who was talking about sort of land cycles and how economies go from boom to bust, and how kind of part of this process is unfortunately rising level of inequality. The title of his work was Progress and Poverty, and actually his main thesis was that in order to see how economies work, you've got to diagnose the boom bust cycle, and poverty is, unfortunately, in the way our system is set up, kind of almost a companion of progress. That was his idea. Anyway, that was my first introduction to the idea of a cycle. Then the second sort of pillar of that was when I was studying at university, and I was a classics scholar. And when you study history over a very long span, you firstly see that actually human experience is fairly universal. And also you become open to the idea that there are grand patterns in history. At least I did anyway. That's what I took from it. And then the third thing was, in the run up to the financial crisis, I started reading a bit about economics. I actually never studied any economics formally. And when we did get the crisis, all these explanations didn't seem to me to make sense. And I remember that the period in the early 90s was also a pretty difficult time. It was quite a significant recession. The UK had to exit the European exchange rate mechanism. Some people might remember that. It was difficult times. It was difficult times for my family's business, both in early 90s and also in the financial crisis. And I thought, well, these two episodes are somehow linked, but no one seems to be talking about it in that way. And so I thought, I'm going to try and figure out what's going on. And next time there was a crisis, my family and our businesses and other investors would be prepared to ride it out.
And in terms of what you've, the studying that you've done, I mean, how did you join the current research organization that you're part of?
Yeah, so I mean, I suppose to continue that sort of story, I started looking into why most mainstream experts weren't sort of joining those two episodes together, the early 90s and the financial crisis of 2008. And so I started reading around the subject, and I came across a small band of people who had actually produced research in the run-up to the crisis saying, in 2008, so we're going to have a pretty bad time, and it's going to be a crisis, and it's going to be this, and it's going to be 18 years after the previous one. And so I started, really looking into it. It actually brought me back to Henry George.
Mhm.
And one of the people that I came across was this chap called Philip Anderson, who'd just written a book called The Secret Life of Real Estate and Banking. And I wrote to Phil and I said, look, if you ever want to write another book, let me know. I'll help you research it because I've got a keen interest in this subject and have some relevant skills. And so we started collaborating. We both, he in Australia, me in the UK, wrote some newsletters for a few years. He already had a subscription service, and we started collaborating a bit more. And eventually, we set up Property Sharemarket Economics in 2019 to pool our subscriber bases and produce both kind of commentary on market cycles, stock market forecasts, commodity cycles. We pooled all our research together as well. It goes beyond real estate into financial markets in general.
Absolutely. Picking up on a couple of points of those quickly, I do want to get into the subject matter of today. But Henry George, was he an advocate of imposing a land value tax?
Yeah. That's, I mean, to be honest, the idea has been around the economics discipline since the beginning. So it's in Adam Smith, it's in some of the other classical economists. But Henry George was the one that really popularized the idea. And obviously you're on a property investor podcast and so on. And so I'd imagine it's a bit of an anathema to many of your listeners. But the idea of a land value tax is it replaces other taxes. So you don't pay income tax, you don't pay taxes on business profits. And the reason that you don't do that is when you work, when you you take business risks and you provide a service to the economy, you're adding value, and that is your own value. It should not be taken away from you. On the other hand, if you own a piece of land in the center of a city and it increases in value, it's got nothing to do with you ultimately. It's to do with the quality of the infrastructure, the number of people in the surrounding area, and so on. And actually, that is and this goes back to the Henry George idea. That is a sign of progress, and that is basically the fund from which the economy should be funded. It should be returned to the public and then reinvested. And I think what will happen is, if it was imposed, is you would have a major business boom, you'd have a major construction boom, and so on. So if you're in the property industry and you're developing properties, actually, you should probably be a rather strong advocate for it.
Definitely. And I mean, the name land value tax will make property folks flinch, but the devil is in the detail with everything, isn't it? And then there's nuance as well. I first came across it in a book called Life After the State, and what I'm not going to become an advocate of it in the middle of this podcast, but what I think is interesting is, imagine if there was no other form of taxation. So all of the the reams and reams and reams of taxation are all dispensed with, and we have a much more simplified tax code, and imagine the possibilities that would follow. Obviously, the property people are going to have to get their head around the nuance and detail of it, because it's not a tax on the property, it's a tax on the underlying land. And there's a huge distinction there. But anyway, that's a discussion for another day. And your business partner, Phil Anderson, I say this with respect. You're the much more measured of the duo. Phil Anderson, he enjoys the occasional good rant, which I enjoy. I have to say, I do enjoy his good rants. But you're the more measured of the duo.
He's been doing it for longer than I have, and so he's seen all these things come and go, and I suppose it kind of gives you a certain perspective after a number of years.
Yeah. He's got very clear views on the news, which perhaps you share. So we'll get onto that later on. But for those that haven't had the opportunity yet to, so I should explain. It's in property circles and hopefully wider investment circles, but certainly in property circles, the 18.6 property cycle is well known. It's one of those things which is discussed frequently. Um, what you brought to the table is this new book, The Secret Wealth Advantage. And it's really, that's the platform for our discussion today, because having looked at the 18.6 cycle for years and years and years, it's actually only when I delved into your book, and particularly the way it's presented in the acts, I found that really helpful, the way that it's now broken down into the acts, that I got a deeper level of understanding. So if we can imagine no one's ever heard of the 18.6 year cycle. Take us to the big picture. Take us to the overview. What's the main premise of the concept?
So the main premise is that in our economies, particularly the UK and the US, because they've had the most sort of longest history in the current form of all countries in the world, there is a 18.6 year boom bust cycle on average, but with very little variation. And so you typically have an expansion for about 14 of those 18 years, and then a crisis at the end of it when the whole system collapses and is reset. And within that sort of 14-year period of expansion, you get roughly 2 7-year halves interrupted by a mid-cycle recession. And so you start in year one, you expand for about 7 years, you have a minor recession, which tends to be fairly short. That sets the scene for the second 7-year expansion, which is much more bullish, speculative, and so on. Things go over the top. It engages the banking system. There's too much leverage in the system, and then it comes crashing down, and it takes several years to sort that out over a sort of final 4 years of an 18-year cycle.
Mm-hmm. And lying at the heart of it is this concept of economic rent.
Yeah.
In I suppose the most simplistic terms,
Mm-hmm.
could you describe to us the meaning of that concept of economic rent?
So the economic rent is basically the surplus of that is generated by an asset, and in relation to real estate, it is its locational value. So you don't well, think of it this way: if you have a plot of land, 10 square meters at the corner of, I know, Oxford Street and Regent Street,
Mm-hmm.
and you set up a business there.
Mm-hmm.
The revenue that generates, given it's in the heart of the biggest city in the country, and it's the most valuable location in that city, compared to, say, a similar size plot of land at the edge of, and with all due respect, Inverness, for example,
Okay.
where there's not too many people. People are not quite as wealthy, and so you could just about earn enough to make the business viable, but pretty much no more. The difference between those two, you're doing exactly the same thing on those two plots of land. They're exactly the same size. You're selling exactly the same thing, but the difference in revenue is the surplus that's attributable to the value of that location, and that is economic rent.
Yeah, excellent. So do you want to talk? So if we just I suppose, for the benefit of those people who haven't seen the graphs, and we'll make sure that we publish we'll link to the graphs as well. But in terms of, if we just revisit those different acts as they're described in the book, and then focus in on where we say, well, what the causes are for those different phases, and then let's naturally move on to the phase or act that we believe we're in now.
Yeah. So just to go back to my previous description of the cycle: 7-year expansion, mid-cycle recession, 7-year second expansion, and then a major crisis. So in the book, I try to take the reader on a journey through a complete cycle. And I think to help navigate through that cycle, I have divided those 4 segments I've just described into 4 acts. So the first one is the recovery. It takes you up to the mid-cycle. So it's roughly 7 years. Then you have the mid-cycle as a second act, which is the sort of recession in the middle of the kind of 14-year expansion of the cycle. Then you have the third act, which is the boom, which is a second 7-year expansion. And then you have the crisis, the fourth act, which is the final 4 years.
Mm-hmm.
So in the book, I say how each sort of act plays out. So I actually divide the cycle into 9 separate stages. And the first act involves the kind of start of the cycle, which is basically when everything is bleakest, and people think, well, we're never going to recover, and there's a lot of unemployment, businesses have collapsed, and there's no credit available from banks.
Mhm.
But actually, that is often the best time to be buying, and we all know when those periods are, because we always spend the next 14 years saying, if only I'd bought then. So buying in Hackney or something in 2010 or 2009.
Yep.
And it sort of slowly expands. It's often driven by a new technology, and people moving around in search of work. And what that does is it kind of changes the kind of structure of the economy to a certain extent. It brings new businesses up, they generate employment and so on. You start to recover again. You then get after a few years, an expansion. People are sort of a bit happier. Property prices have started rising again. Businesses are doing well. And that expansion might, to a certain extent, go a little bit over the top. It gets a bit speculative about 7 years in. That naturally leads into a recession. So we're now in the second act, the mid-cycle recession. They can coincide with some pretty significant events. So in the current one, we had the COVID pandemic, but the global economy was slowing into it. So we probably would have had some kind of slowdown anyway, but of course it was very much exacerbated by the decisions to lock down and kind of effectively freeze the economy for a few months. What the government does in a recession is kind of stimulates the economy, and they tend to lead to fairly rapid recovery, as we saw in 2021. But we had something similar in the previous mid-cycle recession, which was around 2001, and again coincided with a major event, 9/11, and so on, and the start of the Iraq War. Because the economy recovers fairly quickly, and the banks are not affected by the mid-cycle recession, you get a much more, in some ways, bullish, risk-taking second half of the cycle.
Mhm.
And that naturally leads into a land boom. So, as I said earlier, land effectively takes the gains of progress as economies progress. It's owners of land who, because land is a scarce asset, who have effectively monopoly pricing power, and so you get to see the benefits of growth and greater risk taking and technological development. You get ultimately to see it in the real estate market, which makes real estate a great asset to kind of buy and sell. And as the boom takes hold, you see kind of really quite speculative behavior, and banks, because they've survived a recession, are more willing to lend, and actually lending for real estate is a much more lucrative activity than taking business risks and so on. And so that builds on itself for another few years. The final 2 years tend to be a bit of a mania. Everyone's sort of jumping in at the same time because they have FOMO. They want to miss out on a good story, on good investment returns and so on. And that really drives things to the peak, which marks the final 14th year in final kind of period of the expansion. And you can, as I try and show in my book, you can spot the signs. It's difficult because as emotions are running high, the stories are generally much more positive. It's quite hard to see it in the news, but there are certain warning signs. And then it all comes crashing down. There's a crisis. 2 years into the crisis is probably the worst point, when it seems really bleak. But it takes another 2 years to really get the economy reset for the next 18-year period.
Very interesting. And as you allude to there, lending on property and land for the banking sector is a highly lucrative activity. I was once speaking to somebody in a completely different industry, in the commodities industry, and they rather uncharitably said to me, when I said that I had a property business, they said, "Oh, you work for the banks? Oh, that's nice."
Yeah.
Because his view was that anybody who took bank debt was effectively working for the banks nowadays. A very uncharitable view.
Yeah.
Okay, so that's fascinating. So, I mean, one of the themes that emerges from the analysis is is largely to ignore the news, or almost to
Mm.
fade the news. That the news is sending is to do the opposite of what the news is telling you, both in the at the low points, but also the high points.
Yeah.
Perhaps we can explore that a little bit more. But I suppose brings up to the current time then. So what's your base case? Like, where do you say we are now in this cycle?
So we started the current cycle around 2011, probably 2012.
Yeah.
And I don't know if you remember the news from that time. It was, we're about to be in a triple dip recession. I mean, this was very clearly the news at the start of 2012. So again, I mean, back to your point about not reading the news, I totally agree. It uses rubbish. It's really useless. Doesn't tell you what you need to know. So if that's the case, then you would have been expecting a mid-cycle recession around 2019. Things were slowing down then. We had the pandemic in 2020, but we recovered very quickly. So the second 7-year period, I mean, these are averages, but and the mid-cycle, the timing of the mid-cycle recession can sometimes vary a bit, and it can make the first half a bit longer or the second half a bit shorter, sort of thing. Given that we exited that around 2020, you'd expect the peak to come around 2026 or so, and then a crisis to come in the years thereafter. So we are in the second half of the cycle. We are approaching probably the most speculative period of the second half of the cycle.
Mhm.
Now, you might say, well, the news is terrible and so on. And to a certain extent, there are some fairly significant difficulties. And one of those fairly significant difficulties is that we went pretty crazy in stimulating the economy out of the pandemic. I mean, now I'm not saying it was the wrong thing to do necessarily. I mean, you can't ask people to sit at home and not provide some way that they can sort of survive. So otherwise, they wouldn't have complied with it. And I'm not going to get into whether that was the right thing to do or not. It's just it's just how it was. At the same time, we had some very significant changes in the economy, the global economy, in terms of, I mean, we were already starting to break apart. China and the West was decoupling before that. It started with Trump, and well, actually, it started before that, but Trump sort of really kind of pushed it up the agenda, and Biden has continued that. And so that creates more frictions in how things are done. And also a lot of people left the workforce, and people had record savings rates and really wanted to spend money after the pandemic and so on. So you had more expensive goods and people still willing to pay, and some businesses got out of business. And so the ones who remained were able to price things without any sort of consequences, it seems. And so inflation has just gone crazy. But it's coming down now. And everyone was absolutely certain that 2023 would be a recessionary year. And I remember exchanging messages with people on Twitter at the end of 2022, and they said, well, property prices are definitely coming down at least 10 or 15%. And I mean, they're not, I mean, maybe they have in some areas because people aren't, heading off to Frome to buy a sort of a property with a massive garden or something. But there's definitely not been a 15% reduction across the board in property prices in the UK, despite the fact that we've gone from 0 to sort of 5 or 7% interest rates. So people are really not understanding where we are in the cycle. And the reason why things have held up is because we're in the second half. Banks are still, to a certain extent, willing to lend. I mean, obviously, you've got to absorb higher interest rates, and you've got to potentially put down a bit more of a deposit and so on. But again, there's a lot of cash buyers, a lot of people with sort of fairly significant savings and so on. And it sort of kept things going until the point at which it looks like now interest rates are starting to come down again. And I think what's going to happen is it's going to push a lot of people into the market at the same time. And you might see 2024 and 2025 to be quite strong years for both for assets, but in particular for property.
And certainly anecdotally, when I speak to investors, host a breakfast meeting, I speak to investors there was a lot, I can anecdotally say there was a lot of capital on the sidelines, like
Yeah.
vast liquid pools of capital.
Yeah.
because the higher interest rates have made, the calculations of doing deals less favorable. So because the numbers don't look as attractive, people have kind of sat on their hands a little bit, hoping for rates to come down and
Yeah.
then to re-enter the market, which means I suppose that whilst just purely anecdotal, perhaps does support your argument that then we can then see this flood of capital into the market and going off to the races. I mean, you mentioned interest rates, and without wanting to date the podcast too much, but obviously yesterday was the 13th of December, and we had the Fed chairman speaking, and there was an immediate reaction to the market from the marketplace, because it was a pretty dovish meeting, talking of, well, certainly pausing, and then an indication that we're looking at maybe 3 rate cuts of 0.25 during the course of 2023. And as I say, an immediate reaction from the marketplace. The S&P was up, gold was up, Bitcoin was up, and a very kind of, I suppose, bullish narrative immediately coming back into the marketplace. The
Well, I
Sonia,
mean, sorry, I should say the market, I think, has been pricing this in since at least the end of October.
definitely, most definitely,
So,
and we're going to get to that. And so UK swap rates now 3.78, which is a reason, if you're a property investor, is a reason to rejoice, because that it's been challenging for those on commercial loans. It's been a
yeah,
really difficult environment.
but they've survived, have they?
Yes,
Yes. I
yeah,
mean, I think this is the thing. I mean, there's been capital on the sidelines, and I think probably they were hoping that there would be a bit of a crash, and so they could jump in and buy cheap assets. And there hasn't been that. And so then they're probably, waiting for the numbers to stack up, and you're starting to see things move in the right direction, albeit at high prices. But see, the consequence of high prices and inflation has been that rents have gone up quite significantly. And so that will be capitalized into prices at lower interest rates, and so suddenly the valuations are higher, and so on. So you got a lot of moving pieces, but the point is you got to know where you are in the cycle to see how it will play out, how the cards will fall. And I think this is what has been beyond a lot of people in 2023, and even people who uh, with all due respect, have say they've studied the 18.6-year cycle, but then at the first sign of seemingly difficult news have said, "Oh, it's maybe not working as it used to." And I think that, yeah, but every year in the next few years is going to throw up something different. I think you really need to understand the dynamics at play underneath
and
all of it.
we're gonna dive into that in a moment. Just pausing on the subject of interest rates. So we've seen like a widely, as you say, a priced in, widely anticipated pause and predicted change of direction from the Fed. I've often heard an analyst say that the UK is 6 months behind the US. If I can invite you just to gaze into your crystal ball, do you think that's accurate? Do you think we'd be looking into the summer of 2024 and the Bank of England pausing or reversing direction in terms of interest rates?
It's a possibility. I mean, I think the UK has its own unique challenges, and maybe interest rates might need to stay a bit higher for longer than the US. The US, it looks like inflation is coming down fairly significantly, and Powell is probably thinking to himself, he's done what he needed to do to get it down. I personally don't agree with that. I think it's come to the point where people have starting to run down their savings in the US and not spending quite the same way that they used to. Anyway, the UK has its own unique challenges in terms of importing inflation because of needing to import energy prices, and if you're cold winter and so on might do something to that. Also, we have still ructions in our trading arrangements and so on. So I don't want to say necessarily that we'll always follow the US, but it does look like inflation is coming down, and therefore there is the possibility of bringing rates down. I think they might want to still there's still a few strikes going on and so on. They might want to scare people into not asking for higher wages and so on. So you kind of keep the inflation narrative up and going a bit. And you might discern within what I'm saying a bit of cynicism about the whole thing. I think a lot of this is about storytelling and it's about politics. It's not actually about fundamental economics. But yeah, UK is typically a few months behind the US, as is Europe and Australia and other places like that.
And would your case be that you can the model can still work even in the face of higher interest rates? You know, the model.
Yeah.
There's so much going on that leads to the model that the model can still play out despite the higher interest rates.
Yeah, absolutely. I mean, interest rates have not always been at 0%. I recall when I bought my first property back in 2003 that I'd have grabbed the opportunity to get a mortgage at below 5%. It was seen as really cheap. And in relation to my income at the time, you know, I was pretty stretched. So you certainly don't need interest. In fact, I think interest rate story is almost in some ways irrelevant to the cycle. And I think this is what I suspect, because everyone has to borrow money to buy a property, that the rate of interest is a big calculation. But once you've made the decision and you've got the loan and so on, and you kind of fix it at whatever rate, obviously it makes sense from a debt servicing point of view, then you sort of forget about it and it's no longer a factor. But the reality is that and I got one of our team to produce a table looking at all the 11 interest rate rise periods in the US since the Second World War. And in 10 of the 11, during those periods of rising interest rates, property prices went up. And in the 11th one, property prices went down over that period by 0.1%. So rising interest rate environment is not a time when property prices go down because of when it happens in the cycle. So I think really the reality is that interest rates follow property prices, if anything, rather than the other way around. Of course, the reverse is not true, that when interest rates come down, property prices go down. I mean, they do sometimes because interest rates come down during the crisis at the end of the cycle, but also little dips and pauses and so on will probably lead to sort of fairly significant increases in property prices over the next couple of years, given where we are in the cycle and the fact that people have been waiting for something to happen, something to change, and then they don't want to miss out. So they all jump in at the same time and they create the boom that they don't want to miss out on, if you see what I mean. And then as that people see that, you know, they want to get in and so on. It's a good story and other things. So you see it feeding in on itself, and I expect that's going to happen over the next couple of years.
Very good. I want to take us back to this discussion piece that, you know, markets bottomed in October, and I want us to explore what led us, what asset classes are leading us out of that bottom and what that might mean for us. But I suppose just to develop a point that you've made already, which is, I suppose, if I was to ask you to steel man the case for why the 18.6 year cycle is broken, it's not going to apply to the UK. If you were forced to do that, you know, what are the talking points that you would rely on there to say, well, the UK is not going to see this boom on this occasion?
Well, it is a possibility that we somehow don't have quite the boom that we had in the 2000s, you know, when things really went crazy. And we may, that is a possibility because we've spent the last 7 years arguing with each other. We've not really done a lot of sensible things for this era, investing in cutting edge technology, improving our infrastructure. I mean, we've done it in places and so on, but we've really, in my view, from a public policy point of view, wasted a lot of time, important time, when there's a lot of changes going on in the world. And there is a sort of pretty negative narrative around at the moment, and that, you know, clearly is influencing people's behavior. I mean, not necessarily their spending, because we you know, spent quite a lot, and we have a lot more to spend. Our savings are at record levels. I'm not saying everyone has savings, and in fact, some people are in really difficult situations, but taken in aggregate, it's record levels, and so people are willing to spend. But we haven't really made strong investments for the future, and so that necessarily means that maybe we don't have quite as much of a frothy boom as you would otherwise expect. But that doesn't mean that we're not having a cycle, because in some areas prices have been increasing, rents have been going up. That, you know, as I said, capitalizes into higher prices in the future. And it can go over the top. There might be too much building in certain areas, and it's often not in. We're not talking about London. It might be talking about smaller secondary or tertiary cities, and at the edges of those cities, as I outline in my book, it's actually those areas which are the things that trigger a crisis. It's not so much what's going on in the centre of London, because there's always going to be demand for that property, and there's always going to be people who are able to pay high prices or pay high rents. So I think that's probably the direction that I'd come from in relation to the UK specifically. And the other thing is, it's a global cycle, and actually very crazy behavior elsewhere can affect us quite badly. And, you know, if people are traveling through the Middle East will see there's a massive construction boom going on. But it's not just in the Middle East, it's in India, it's in Indonesia, it's in parts of Australia, it's in parts of the United States, it's all over the place.
Yeah. You also, very interestingly, when you mentioned crazy behavior, you've pointed to, outside of, let's say, the investment landscape, really extravagant, unusual behavior beginning to seep into daily life. Do you want to give us some examples of that and how that feeds into the work you do on cycles?
Well, there's that sort of, I mean, there's any number of tall buildings. You know, I think they've announced the tallest building in the city, not quite as high as the Shard, but in the city of London. There's that crazy moon-shaped hotel in Dubai, I think it is. There's the Kingdom Tower in Jeddah. There is Saudi Arabia buying up all sorts of sports teams for you know, astronomical prices. John Rahm, I don't know if you're a golfer. John Rahm, you know, one of the world's best golfers, has defected to the Saudi Golf League for $300 million. Can you believe that? $300 million. My friend Phil was quite struck by the everyone getting dressed up to go and see Barbie and Ken, or whatever the film was called. I haven't seen it yet, clearly. You know, it's not, I don't want to imply any kind of judgment or criticism. It's just an example of the type of behavior that you come to expect. It's quite, in some ways, quite lavish. It's quite hedonistic. It's fun. Don't get me wrong. It's fun. It's colorful. And it's also a bit distracting. Taylor Swift's $1 billion concert around the world, you know, there's a concert tour, things like that. And I think we'll see more of that. Record prices at IPL, Indian Premier League cricket auctions, or, you know, we've just record deal for the Premier League TV rights. You're starting to see examples of in a lot of arenas, things breaking records, which is often a sign of where we are in the cycle.
And you make a really important point. You're not saying there's any sense of judgment. I mean, you know, we're all Taylor Swift fans, obviously, but
obviously,
it is about it's a signal, isn't it? It's indicative that we're in a boom phase. These things wouldn't be necessarily happening in a downward cycle, for example. Although I know, you know, as no doubt you have come across, you know, I frequently bump into people and know people, highly respected people. I really respect their judgment. You know, their base case now is that the peak is over. You know, that their base case is we're now into the cycle of 4 years of you know, a downward progress. But obviously we'll see what unfolds there. What I want to circle back to is you made a really an interesting point, and I've seen your work on it, about what's leading us out of this bottom. And, you know, one of your arguments is to look very carefully at what moves first, and because that can help us understand the future. So do you want to talk a little bit more about that?
You're talking about the stock market,
Yeah.
or
Or
um,
the various asset classes that seem to have found a bottom in October and seem to be making progress. And within the stock market, the sectors that seem to be moving first.
um, well, it's a bit more difficult in this era in the stock market simply because AI seems to be the big story, and so
Mhm.
normally you wouldn't expect, well, historically, and I'm not going back very far because I don't have data, but maybe 50 or 60 years, the Nasdaq or technology stocks have tended to have a stronger first half of the cycle, and that's been taken over by a kind of quote unquote real economy stocks in the second half. Um, I think we're now in an era where basically everything is technology driven, even lending, building, etc. So the things that you would normally expect to have a stronger second half of the cycle,
Mhm.
um, is AI is going to be influenced by AI, or at least the possibility seems to be the case. So it's a bit of hype maybe, but investors are certainly buying it. So it's been driven by tech related stuff, and in fact, it's been specifically driven by the big seven um, tech companies in the US. Um, I don't know if that will continue to play out over the next few years, or if other things start to catch up. It's a bit hard to say, and wouldn't want to make too much of a prediction right now because I think we just wait and see how it plays out. You tend to find, as I outline in my book, and I do really encourage people to really pay close attention to sort of chapters 10 to 14 because that describes um, where we are in the current cycle and what you need to look out for. Um, it tends to be that the dollar falls during the second half of the cycle, and that's partly because um, uh, people are a bit more risk on, as it were, so they're willing to take more risks. Um, and so they are so that's kind of leads to falling dollar. You're away from the kind of safety of the dollar and so on. That's great for global trade, and that boosts the global economy and so on. And when you have a falling dollar environment, it's good for commodities, and it's good for things, as we're seeing in this era, good for Bitcoin,
Mhm.
um, and to a certain extent good for gold. But gold, except at the end of the cycle, tends to follow the trend of commodities.
Mhm. And I mean, obviously, people are going to have to read the book. We're going to signal people to where the book is. I mentioned in preparation for this podcast, not only do we have two copies of your book lying around our house because I've gave one to my business partner, life partner, Liz. So we've both read the book, but also it's one of a handful of books that I've that sort of really doubled down on and listened to the audio and had the book. I've done that there's about 5 books on the face of the planet I've done that to, and this is one of them. And so I think I would highly recommend that as a strategy is do buy the book, but also do listen to it. And
Mhm.
the interaction between the two I highly recommend.
Interesting.
Um,
I'd be interested to know at some point what the other 4 or 5 books are, what company I'm keeping. But anyway, you don't have to say now.
well, I'd be interested in your views on a couple of them. So have you studied the work of Neil Howe and the fourth turning?
I haven't studied it. I've come across the main thesis and so on. Yeah.
So he's produced a sequel to that. The fourth turning is here. So
It's here. Yeah. Yeah.
that's
I saw that.
an example of that, which
Okay.
I find a very interesting one, and interestingly fits reasonably well with your cycle. And the other one, another obvious example, is Ray Dalio's book, um,
Which one?
The Changing World Order.
Okay.
Um,
Yeah. Yeah. Yeah.
that's always worth doubling down on both of those.
Nice. Very good. Good company for me.
Yeah, excellent company, I would say.
Or maybe good company for them. I don't know.
Of course.
Yeah.
So as we move to a bit of a conclusion, just looking at some final thoughts. So
Mm.
um, obviously investors can, whilst nothing in your book is no doubt financial advice or anything like that, refer back to the earlier disclaimer, but they can look for action steps within the chapters of your book. Equally, outside of the book, you're an advisor to a fund, and it's a really interesting fund because the fund expresses your view in its investment strategy, and you're an advisor to that fund. Do you want to give us a sentence about the fund?
Yeah, it's based in Australia. So it's the 18.6 strategic investment portfolio. It's a sort of managed portfolio. Um, it's open to international investors, but it's based in Australia. And actually, I think partly because you tend to find that commodities do well in the second half of the cycle, and the Australian dollar appreciates against a lot of other currencies. So you get a kind of a dual or maybe even a triple return from the cycle, from commodities, and from an appreciating Aussie dollar. Yeah, it's designed to put into practice some of the principles, i.e., you expect real estate and cyclical stocks to be quite strong in the second half, that you are cognizant of the fact that you can go over the top, so you don't overdo it towards the end. That you look for opportunities to at least preserve your capital when it comes crashing down, as it will at the end, and also potentially take advantage if you can find some exposure to falling stock market through shorting or funds that move inversely to the stock market. I have to say though that the one downside of at the moment being in Australia is that the market's been going sideways for as the UK market has been for the last year and a half. And that's partly because, as I said, all the hype and all the investor interest has been in AI. And unfortunately, the UK and the Australian stock markets don't have much exposure to that. But I fully expect that the next couple of years, that sort of trend it won't reverse, because AI is clearly here to stay. But commodities and other things, construction, finance companies will come back into their own.
Yeah, absolutely. And interestingly, just again, anecdotally, and this is the last podcast of 2023 for me, I have often asked both on the podcast and in private guests, what do you think we're underinvested in as investors? And the single answer I've been given all year is commodities. Everybody's looking at commodities saying, look, none of us have that exposure for where we're going next. We are going to need commodities. That's the reality of it. Okay, so bringing this to a conclusion then. So what's the best way that people can connect with you if they've enjoyed what we've discussed today, it's resonated with them and they want to learn more? Where's the best place we can take them to?
So two places. One is get a copy of my book in whatever format you'd like, paper, Kindle, or audio, or all three. If you want to get more regular updates, you can become a subscriber to Property Sharemarket Economics, and we have a free newsletter, so you can sort of kind of see that and decide if it's something you want to take further. And then we have a couple of different paid newsletters, depending on how far and how deep you want to go into the cycle.
Perfect. Excellent. And I'll put some links in the show notes. I highly recommend seeking out the book. So it's called The Secret Wealth Advantage. You'll find it on Amazon. You'll find it on Audible, but you'll find it in all the other good places as well. And it's easy to become cynical in these modern times. So even with a cynical mind, it's worth it at least glancing over just to see, what people are talking about. Look, Akhil, I'm really pleased we managed to get this on. And I'm really thrilled that we've got it on just before Christmas as well. Thank you very much for coming on the podcast. It's been an absolute pleasure.
It's been great. Thank you for having me.
Oh, fantastic. So there you have it, ladies and gentlemen. The last Property Investor podcast of 2023. Please come and join me in January at my first breakfast, where we'll be looking at the direction of travel to 2024. And no doubt this discussion hopefully has added to that. Click on the link below. Come and join me in January. Please do follow and subscribe to the podcast. It makes a huge difference on the platforms, just the most amazing difference on the platforms. Keep well. Speak soon. Thanks very much for listening to the podcast.